Let's jump into the Chapter 4 taxation review. Now in Chapter 4, we looked at how to calculate taxable income, tax credits, and tax payable. Now remember, there's a difference between net income for tax purposes and taxable income. Net income for tax purposes was what we looked at in Chapter 1, 3A plus 3B minus 3C minus 3D. That was our net income for tax purposes, and that was based solely on current year amounts. Now, to go from net income for tax purposes to taxable income, there's a number of common deductions that we could make if we qualify for. The first one is stock options. Now, remember we said that in Chapter 3, if an employee exercises a stock option, they need to include certain amounts in their employment income. If they qualify for this 50% deduction, that would get deducted when calculating taxable income. Also, if an employee gets a home relocation loan and they get it at a low rate or no interest free loan from their employer, then the first $25,000 principal, a calculation could be done using the first $25,000 of the principal, and that deduction would get deducted here when we calculate taxable income. Now, one thing to note is that this deduction for a home relocation loan, the last year to qualify for that is 2017. This deduction is repealed from 2018 onward. Now, if a taxpayer has loss carryovers, let's say certain net capital loss or non-capital loss carryovers from other years, they could apply it when calculating taxable income. Now, once we calculate taxable income, we use that number to calculate the individual tax liability before their tax credits. That's where we use those progressive or marginal tax rates. Now, the tax rates change every year, and also we said that in class, we're just going to focus on the federal tax liability, not the provincial tax liability, because the provincial tax rates vary from province to province. Moving on to the next slide, let's talk about tax credits. Now that we've calculated the tax liability before tax credits, how do we go about calculating these tax credits? Well, there's a number of tax credits, and generally a taxpayer would just add up the base amounts and multiply that base amount by 15%, and the corresponding amount would reduce their tax liability. Now, there are certain exceptions. For example, charitable donations. With charitable donations, the first $200 is multiplied by 15% to get the amount that gets deducted from the tax liability, and the amount over $200 could either be applied at a 29 or 33% depending on the taxpayer's tax bracket. Some common tax credits, everyone gets the basic amount, and once again, these amounts change every year, so once again, use the correct amount for that particular year. Now, if the taxpayer has a spouse or common law partner, then they might be able to qualify for the spousal tax credit. However, the spousal tax credit amount gets reduced by the spouse's net income. So if both the taxpayer and the spouse work full-time and they both make quite a bit of money, then they may not qualify for the spousal tax credit. There's also what's called an eligible dependent. Now, for example, if we have a taxpayer that is a single parent, of course they have no spouse, so they would not be eligible for the spousal amount. They could claim the eligible dependent if they have a child. There's also a Canada caregiver amount, which is new for 2017, and this replaces 3 other types of tax credits that were in place in 2016 and prior. And this sort of relates to certain family members that might have some sort of infirmity, and once again, there's certain conditions that need to be met in order to qualify to claim this Canada caregiver tax credit. Now, many tax credits have an income threshold. What that means is if the dependent that the taxpayer is trying to claim the tax credit for has a high income, that tax credit base amount might get reduced, or it may be totally eliminated. Moving on to the next slide, some other common tax credits with respect to employment income. If the taxpayer pays employment insurance or CPP, or this could even be for self-employed individuals that pay employment insurance and CPP, they get a tax credit for those two amounts. And also there's what's called the Canadian employment amount, which applies to just employees that earn employment income. There's a first-time homebuyer's amount. If neither the taxpayer or their spouse owned or lived in a home in the preceding 4 calendar years and they buy a new home, then they could qualify for this first-time homebuyer's amount tax credit. Public transit passes. Now with public transit passes, this is only available up until June 30th, 2017. On July 1st, 2017, this amount is repealed and is no longer available, but it would be available up until that point to the taxpayer, spouse, common law partner, and any kids who have not yet attained the age of 19 in that year. So this would not apply then if a taxpayer pays for transit passes for their, let's say, in-laws or their parents. It would only apply to the taxpayer, spouse, common law partner, and kids that are not yet 19. There's also a medical expense tax credit, B minus C plus D, and the D is further expanded to E minus F. Now, B minus C is the amount for the taxpayer, the spouse, and any dependents that are under the age of 18. If the taxpayer has a dependent that is 18 years or older, that's when the D amount would apply. Now, in your textbook, you might also see that there's this A amount, A times B minus C plus D. Well, the A is basically the 15%. Remember we said that there's a base amount that we calculate and then we multiply that by the 15%. That A amount that you might see in your textbook is the 15%. Now, if we look at specifically the C and the F amounts, those are basically income threshold. And so once again, the C and the F are the lesser of 3% of the net income, or for 2017, it's $2,268. And once again, that amount changes year to year. Let's move on to the next slide and continue on with other tax credits. Education-related tax credits. Now this applies if the taxpayer goes to a qualified post-secondary education institution and they pay tuition. And so once again, that tuition amount qualifies as a tax credit, multiplied once again by the 15%. Now, prior to 2017, there were other tax credits that were available with respect to education. The education tax credit and the textbook tax credit, those are no longer available from 2017 onward. So once again, just sort of note that these two tax credits, the education and the textbook, the ones that are striked through on your screen here, those were available in 2016 prior, but are no longer available from 2017 onward, just the tuition amount. Now, if the student cannot use up the full tuition amount, which is the case because they're probably attending post-secondary schooling full-time or part-time, they may not have enough income to use up the tuition tax credit. Well, that student can carry it forward an unlimited number of years. However, up to $5,000 of the base amount could be transferred to the taxpayer's spouse, common law partner, or even the parent or grandparent. And once again, the spouse, common law partner, parent or grandparent could use that $5,000 base amount as their own tax credit to help them reduce their taxes payable. What about interest on student loans? Well, interest paid on student loan also available as a tax credit. Now, the interest on a student loan can only be claimed by the student, and if the student can't use it all in the year that the interest is paid, then it can be carried forward for 5 years only. So that brings us to the end of the Chapter 4 material. And once again, the best way to master this material is to read through your textbook chapter and do the corresponding exercises and problems. That brings us to the end of the Chapter 4 tax review.